it's not just that the cure is worse than the disease, if the critics of Keynesianism are right, it's that the disease is being caused by the so-called cure, that what the Keynesians are administering as medicine is actually the poison in the first place. And then what they're seeing now is, oh, wow, this patient's really sick. It's because the Keynesians administered their treatment the last cycle, and that's what is causing this patient to come in. And so they're, oh, I guess we just got to give them more. So the Keynesians focused on just money and spending, and the real business cycle theorists said, no. The problem when there's a recession, that's a real phenomenon, meaning there's something going on with the physical economy and the movement of wheat and factory output, things like that.
Welcome to InFi, the future of finance.
Hey everybody, welcome back to the InFi podcast. In this episode, I am going to give a crash course in how various schools of thought explain the business cycle. So this is going to be a very high-level overview. The representatives of each school of thought, except for the Austrians, which is the school that I belong to. So I'm going to end on that note and say they're the best, of course. The other schools of thought representatives will probably feel like I gave them short shrift, but I think what I'm going to say in this video is accurate. And again, you can go watch videos made by the proponents of the other schools of thought if you want to see things from their perspective. But in this video, I'm going to explain the pros and cons of the various schools of thought when it comes to business cycle theory. And like I say, I'll end with the Austrian school because I think that's the best game in town, as they say. And incidentally, when people ask me, why are you a card-carrying member of the Austrian school? Like, don't you like Milton Friedman and Robert Lucas and people like that and Thomas Sowell and whatnot? And so what is it about the Austrians specifically? And that's my go-to answer is I think it is the theory of the boom-bust cycle is developed by Ludwig von Mises and elaborated upon by Friedrich Hayek. And that was partly why Hayek won the Nobel Prize in '74 for his work on extending Mises' business cycle theory. To me, that is the distinctive Austrian contribution. So it builds on the other ways in which they're different from the other schools of thought. So I'm not just saying the Austrians are like the Chicago school, except for the theory of business cycles. Like, no, the Austrian, specifically the Misesian explanation of the boom-bust cycle draws on the Austrian understanding of the capital structure in the economy and what money is and how does it function and what does the price system do and entrepreneurship, all that stuff you all need to know as the basic ingredients to then build up to Mises' explanation of why are there boom-bust cycles in modern market economies. If you're interested in this stuff, the best single thing you can do is, I would say, in terms of the progression of your own understanding, is get my book Choice that was put out by the Independent Institute. So that's like a 300-ish page distillation of Mises' book, Human Action. So it's shorter because Mises' book is many hundreds of pages more. But also I wrote it in language. My mandate when writing that book was it has to be accessible to an undergrad college student so that this could plausibly be assigned, for example, in an undergrad economics class if the professor wants the kids to really know something about Austrian economics. All right, so that's where in the design of that book and the layout of it, I built step by step to make sure that by the end of that book, I could explain Mises' view of the business cycle and the reader would walk away from it. But in lieu of you going and reading a 300-ish page book that I wrote, in this video, I'll give you a crash course in how different schools of thought have approached this important topic. Okay, so first, let's start with the classical economists. And so here, the quick summary is distilled by what's called Say's Law, after J.B. Say. I'll put in the show notes here, folks, if you want to go get more on this. But I have done an entire episode and then even a follow-up on this topic. If you want to see me, and I'm actually defending Say's writing on this. Okay, so this should not be construed right now as me throwing J.B. Say under the bus or saying John Maynard Keynes was right when he dismissed Say's Law and Keynes' general theory, for example. That's not what I'm saying here, but I do want to acknowledge the strengths and weaknesses of this old classical school approach. And by the classical economists, mean people like Adam Smith, David Ricardo, J.B. Say, even Frederick Bastiat. So the great economists who came before what's called the marginal revolution that happened in the early 1870s. Okay, so the ones coming before that. So the great virtue of the classical economists is they could abstract away from money and see through to the underlying real. In economics, by the way, typically when people say real, they mean as opposed to nominal. Those might be two different terms you'll hear. And so real means like the underlying physical goods and labor hours and things like that, whereas nominal means like the money prices. Okay, so you could say something like, oh, nominal wages went up by 30%, but when you take account of price inflation, really real wages only went up by 2%. Okay, so there you're saying, yep, you're getting paid more per hour, but when you go to the grocery store, your extra dollars don't buy that much more food, right? So the real refers to the underlying actual physical goods and services and so forth. Okay, so what I'm saying is the classical economists were very insightful in abstracting away from money and looking at the underlying real activities going on. For example, Adam Smith in Wealth of Nations, part of what he did there was he showed why the old school mercantilist program was misguided, because they thought, oh, the way a wise king enriches his country is to perpetually run trade surpluses, that we want to be exporting more than we import. So that means in any given year, we've got more gold and silver coins flowing in than flowing out. And that's how we enrich ourselves. But Smith pointed out that no, actually the standard of living, the real wealth of a population is how much do they get to consume year in and year out, right? It doesn't do you much good if you're piling up gold and silver coins and your people are starving or nobody's living in anything better, more elaborate than a hut. The classical economists were good about piercing beneath the veneer of just the flows of money and looking at the real transactions underlying it. And so when it comes to J.B. Say, what he was criticizing was the explanation of a business slump, like a quote, bad economy. People of his day would say, oh, there's a dearth of money, that if only, like the business owner might lament and say, if only my customers had more money, then they could buy my products like they used to when times were good and business was brisk. And so they might lament this general shortfall in how much money there was in the community to be spent or how much spending was going on. All right, so in modern terminology, we would say, oh, they would blame the recession on a shortfall in aggregate demand. They didn't have that exact terminology back then, but that was the idea that way back then J.B. Say was critiquing. And so he said that in general, no, it can't be that our society is plagued by a lack of demand. He was saying the reason your customers, if you're a business owner, don't have enough money to buy your product is because they haven't produced themselves enough. So the idea was, how is it that your customers have the means with which to buy your product? It's because in their own activities, they must have produced for other people in the community. And so there, J.B. Say, again, he was seeing beyond just the surface phenomenon of, oh, when a customer comes in to buy stuff from my store, he gives me money. And so if I want to just become more profitable or have a better week, I just need my customers to have more money. And if that's where you stop the analysis, Say was pointing out that's very superficial. Okay. So that's fine as far as it goes. And he's right, J.B. Say is, that it is an inadequate diagnosis of a business slump to just say, oh, the community doesn't have enough money, that's not really what's going on. And partly because then if that's what you thought were the problem, the solution would be, oh, well, I guess if the government just dumps more money in, then everything will be fixed, right? And that's not correct. Okay, so the problem though with that is, strictly speaking, let me back up. So the way Say formulated the issue is that he said the means by which somebody demands your products is that he supplies his products perhaps to somebody else, like earlier in time. All right, and so the way it was distilled down, so-called Say's law, was supply creates its own demand. All right, so J.B. Say didn't literally say those words, and there's a way you can interpret that prima facie where it's clearly a ridiculous statement. If I make a bunch of cakes that are full of rat poison and smell horrible and so forth, it's not that, oh, my supply of those cakes will create its own demand. Like, if that's what you mean, that anything you build necessarily, there'll be some kind of feedback mechanism in the system whereby someone will want to buy it. That's obviously not a true statement. All right. So if that's what you thought Say is claiming, then obviously he's wrong. So no, what he was claiming was something much more nuanced and sophisticated, and I think has a lot of wisdom behind it. However, I don't think it's literally true. It would only be literally true in a barter economy. Okay. And so here's what I mean. If somebody has oranges and somebody else has apples and they're thinking about trading, then the guy who has the apples, when he's saying, why is it that my customer here isn't demanding more of my apples? Well, you could say, well, it's because that guy's not supplying enough oranges, right? That the way he's going to demand more of your apples is by supplying more of his oranges. And so you see, if it's a barter transaction, those two ways of looking at it are literally opposite sides of the same single transaction. And so there is a definite mechanical sense in which the way that the orange owner demands apples is by supplying oranges, and vice versa. The way that the apple owner demands oranges is by supplying apples. Okay, so you can see the intimate, I meant to say, relationship between demanding one person's products only by supplying your own. All right, because it's all collapsed into the same transaction. And so it would be silly to try to draw a distinction between people in the community demanding one person's products versus the people in the community supplying their own products. It would necessarily be the same thing. Okay. And so if the community if there was a slump, you could rightfully argue that, oh, well, the problem here is that people aren't bringing enough goods to market, that for some reason the supply they're offering for sale is lower than it was before. Then maybe you could isolate, well, what it was, the harvest failure, was there a storm, what happened? Okay. So that's the way in that kind of a world, the observations Say was making would be literally correct. Okay. But in the real world, of course, it's not typically the case that when people want to demand products from one person, they bring their own wares and they have a barter trade. No, usually what happens is you're spending money that you acquired in the past. And so that's breaking up the transaction into two different ones. So the guy who has oranges, if he wants to get apples, what does he do? He first sells his oranges to people in the market for money. Then he takes the money and goes to the apple seller and trades money for the apples. And so that's breaking the two up. And that introduces the possibility of something going wrong coming in from the monetary angle. And so, for example, it is possible that everybody in the community could be trying to hoard money. All right. I'm not endorsing that terminology, and I'm not saying that's the way to think about what happens in a recession, but I'm just saying somebody who did think that was a possibility, Say's observations don't knock that out. Whereas when it comes to, if it were just a barter community, it couldn't be that there was in general a lack of demand, because that would be the flip side of a lack of supply. You get what I'm saying? Whereas you can imagine if there's a money good, it is possible that everybody in the community has what's called an excess demand for money and an excess supply or a glut of everything else. Okay, that's the idea. That's maybe one way of looking at it. So one way of talking about what Say was attacking was the idea that there could be a general glut, that just in general there was too much production, and now everyone's just sitting around scratching their heads saying, oh no, we all made too much. All the business owners are saying, we got too much inventory piling up on the shelves. Shucks, the people in the community just don't have enough money or enough demand to buy all the stuff we brought to market. And Say was saying that's crazy. In general, everybody producing more is how we get ahead. Like, that's why our standard of living rises compared to the past. And so in general, to say the problem with our economy right now is everybody's producing too much, that's goofy. Say was saying, really what's going on is maybe some sectors produce too much, but that means other sectors produce too little. So the issue was not a general overproduction, but that faulty coordination about the right types of production in certain sectors versus others. And so, like I say, in a barter economy, you can clearly see that. It would make no sense to say everybody's trying to sell too much, because the act of you trying to sell more means you're lowering what you're asking, the exchange ratio against somebody else's goods. Right? So it couldn't be that everybody is trying to sell too much at the same time. That doesn't make any sense, right? If they're all whereas if there is an intermediate money good, then the accounting does work out. And yes, it could be the case that everybody's trying to sell their goods too much and they're all trying to scramble and acquire more money than there is to go around. Okay, so that's the distinction I'm making. Okay, so let's keep moving. So then the next school of thought is the Keynesian school. And so here this comes from John Maynard Keynes, crystallized it in his 1936 book, The General Theory. And so there he said that, the classicals, they were right in terms of the arguments they made about the trade-offs of, hey, government relief programs or the government spending money to build a bridge or something like that doesn't help anything. The classicals, at least the free market, laissez-faire types, argued, because that's just transferred employment from one sector to another. If the government hires men to go build a bridge, that's sucking labor hours and other scarce resources from other potential uses over to the bridge. That's not going to increase total employment or total income in the community, right? It's just going to redirect where it gets deployed. And so Keynes was arguing the classicals are wrong for thinking that in general. What they're talking about there is the special case when the market economy on its own has full employment. And in that special case, Keynes argued, yes, the classical wisdom holds. If the government wants to build more bridges, it's sucking men and other resources from other lines. And so bridge production goes up, but that doesn't mean total, they would have said GNP back then, goes up, because that means house production goes down or whatever. And so it's just rearranging the form of total output. It's not increasing the total flow of output. But Keynes said, that's just the special case of full employment. We can show, he argued, that the market economy left to its own devices can get stuck in a rut where total investment in consumer spending is not enough to maintain full employment. And the market can get stuck in a rut like that, and the mechanisms, the feedback loops and whatnot by which the classicals thought the market would quickly dig itself out of a hole like that, if there's large-scale unemployment, wage rates would just drop. And that would make workers more and more attractive to employers until finally the employer would hire everybody, and then we get rid of that glut in the labor market. And Keynes releasing his book in 1936, when we're 7 years into the Great Depression, people thought, this guy Keynes is right. The market economy left to its own devices can just get stuck in a rut. And it's not just that wages falling will fix things. Incidentally, I totally dispute that conventional history. What characterized the 1930s was that governments and central banks around the world deviated from their old approach to a financial crisis or a shock, or they could call it panic back in the day. Even Herbert Hoover, despite what you may have learned in history class, Herbert Hoover was the most interventionist into the economy, at least in peacetime, of any U.S. administration up to that point. All right, so it's not at all the case that Herbert Hoover was a do-nothing guy who said, I'd like to help all these people and bread lines and whatnot, but I can't because the Constitution's tying my hand. No, wasn't his position at all. He later wrote his memoirs trying to justify his own record is by pointing out all the ways in which he had massively expanded the federal government's role in fighting a downturn. And he wasn't lying. It wasn't that he was just making up stuff to cover his butt or something or to try to save his reputation. Even people from Roosevelt's administration admitted in the late 1930s that, everything we did with the New Deal was just an extension of things that Herbert Hoover had done in his single term. Right? They didn't say that in the 32 election, of course, but what they did say, incidentally, FDR in the 1932 election, right? So Herbert Hoover won the 28 election. He was in office when the market crashed in 29, and then unemployment shot up to a shocking 25% by 1932. And that was when the FDR ran against Hoover. And one of the talking points in FDR's stump speeches was to rail against the profligate deficit spending of the Hoover administration. Roosevelt saying, here, while households are having to tighten their belts and so forth, we got this bloated bureaucracy in Washington wasting your precious tax dollars and your other dollars that they're borrowing and spending your future taxes. Okay, so that should just show you that it was not that FDR was running on, hey, they're being tight-fisted in Washington and we're going to open up the spending spigots and rescue you. That wasn't the rhetoric coming out of FDR when he was originally campaigning. Just to give you an idea. If you want to see more on this, I have a book, The Politically Incorrect Guide to the Great Depression and New Deal. So I will link to that if you want to check that out. Okay. But put that aside. What Keynes then said is, okay, so the way you get the market economy out of one of these ruts, there's a two-pronged thing. First, the central bank can enact easier money policies. So that involves cutting interest rates and flooding the credit markets with more money. However, if the shortfall in aggregate demand is severe enough, Keynes argued, even if the central bank pushes interest rates down to 0%, it could still be the case that even with interest rates at 0% and how much you would think that would stimulate private consumption spending, or because consumers can borrow more or they don't save as much with interest rates being lower, so they spend more on consumption. And businesses, as interest rates come down, other things equal, you might expect them to borrow more to invest in factories or whatever. And so in general, you would think lowering interest rates would goose private and consumption and investment spending. But Keynes was saying you could imagine scenarios where that's not enough. And even at what you call the lower bound of interest rates getting down to 0%, that still might not fix it. And so then you're in what's called a liquidity trap. And the federal government has a role of coming in and spending money to run a big deficit. And that's how you're going to prop up aggregate demand. Okay, so was the interaction there in the old school Keynesian framework. So with all that stuff, the issue was spending is not high enough, right? So it's ironic that Keynes was just dressing up with mathematical formalism, the old conventional complaint that going back to J.B. Say, that he was trying to knock down, to say, no, the problem when there is a recession, I don't know if Say use that term, but when there's a slump in business activity, it's very superficial to say the problem is there's just not enough spending, but that's not the issue. The economy is a very complex system, and it's not hard to get people to spend. The hard thing is to get them to produce, and in particular to produce in the right proportions in the various lines. That's the tricky part. Okay. So anyway, that was the Keynesian solution. And what was the downfall of that? The original old school version of Keynesianism, though sometimes called hydraulic Keynesianism, was that it didn't account for the expectations on the part of workers. Okay, I'm focusing on one little thing here, but this was what discredited Keynesianism among the economics profession, that there was this idea, this thing called money illusion that it relied on to say, oh, the workers, if the government's pumping in more money, that workers can be fooled because their wages seem to be going up in money terms. And so that reassures them. They go out and spend more, or they might return to work and so forth. But actually, they're experiencing a wage cut if prices are rising faster, right? So if wages are going up 5%, but in general, prices are going up 7%, the workers are actually getting a pay cut in real terms. And so that's what's going to allow the businesses to be willing to hire them. But the workers aren't turned off by the reduction in real wages because they're fooled like, oh no, I'm getting a raise. This is great. Okay, so this is just one sliver of the whole Keynesian program, an element of it. But I'm just saying that was the thing that economists over time said that's not true. Labor unions, once they catch on to that, are going to build in cost of living adjustments into their contracts and so on. And so just dumping in a bunch of money is not going to get us out of a rut, that it'll just shift the problem. And so what happened over time is this, in the 50s and 60s, the central bankers running the Federal Reserve in the United States, they thought there was a trade-off between inflation and unemployment. And they thought we can get out of a recession if we just pump in enough money, and that's going to reduce unemployment, give the appearance of prosperity. The downside is, though, that's going to put upward pressure on prices. And so we're going to have this trade-off that, yeah, we can push unemployment down to 4%, but that will make CPI inflation rise. And so it's just a matter of where on that trade-off do you want to lie. We can, if you want to get inflation under control, we can certainly slam the brakes and stop pumping in money, and the government can run balanced budgets, but that will get CPI inflation down to whatever level you want, but then that might make unemployment surge. Okay, so that's what they thought they were playing with, is that trade-off. And the problem with that is over time, that trade-off got worse. That as the workers caught on, and labor unions in general and consumers and so forth, and got used to it and started expecting inflation, then that just kind of moved the menu out. And so now, if we want to keep inflation down to 2%, maybe in 1955, that just would have required unemployment to be 5%. But maybe by 1975, to get inflation down to just 2% a year would have meant unemployment would zoom up to 12%. I'm just making these numbers up. I'm saying that was what they were observing over time was, yes, it looked like in the short run, the central bank could sort of maneuver around this trade-off of getting more or less unemployment for inflation. But that trade-off was just getting worse over time as everybody was getting wise to what was going on. That was the idea. Okay. And so that was the downfall of old school Keynesianism. And they were being criticized by people, especially like associated with the Chicago school, guys like Milton Friedman, and then Robert Lucas was one. And so part of what was happening is the Keynesians were just focused on money and the flow of expenditures. And so they were just like, oh, if there's a recession, the problem is people aren't spending enough. So what do? We just got to get more spending. We can flood the credit markets with cheap money, push down interest rates. Does that fix it? Oh, if that's not enough, well, then the government can just come in and borrow money and spend. Because the important thing is just to get aggregate demand up. And they weren't so much concerned about why are we in a slump in the first place. And here, I'm not putting words in their mouth. Even Paul Krugman, after the housing boom and bust and the financial crisis in 2008. So if you remember, so Barack Obama comes in, he wins the election in the fall of 2008. He's sworn in early 2009 and proposed a stimulus package, a recovery package, and Republican right-wing conservative libertarian types were, of course, arguing against that stuff. And so Paul Krugman steps into the fray to argue on behalf of activist Federal Reserve and federal government intervention to pick the market economy up out of the slump into which it had fallen. And there were free market economist types talking about, oh no, these low interest rates, that's what caused the housing bubble in the first place. And so if we're all agreeing that the problem was excessive debt issuance and artificially low interest rates, and that's what caused this unsustainable bubble that then when it popped gives us the financial crisis, the last thing in the world we should be doing right now, speaking like in 2009, 2010, is having the Fed do all these rounds of QE, pushing interest rates back down to zero, and having the federal government run $1 trillion deficits, all of which was happening. If we're right and that's what caused the last crisis, aren't we just sowing the seeds for an even bigger crisis by doing this? And Paul Krugman literally said, the important thing right now is we have to restore aggregate demand. Let's not worry about what caused us to get in this position in the first place. Right now, it's like we're doing triage. The patient's in front of us bleeding out. We got to rescue the patient. And then later we can talk about the root causes of why did he get shot in that drive-by shooting or whatever. I'm putting more words in his mouth, but that was definitely the spirit of what Krugman was saying is, no, right now, the problem with the economy is a lack of aggregate demand. We know how to fix that. Let's go ahead and do that. And then once we get out of this crisis and rescue all these millions of people that are out of work, we can go back and scratch our heads and try to figure out what reforms do we need to put in place to try to avoid this. So there, I'm saying that to me, the weakness of the Keynesian approach is it was just naively, I would say, diagnosing a recession as a lack of spending. So how do you fix that? Well, just create more money or have the government borrow more and spend it. Duh. And to me, that's an extremely superficial view, especially if, as we're going to get to later, the reason we found ourselves in that slump in the first place with a lack of sufficient spending is because of prior rounds of government pump priming. Okay. And so again, it's not just that the cure is worse than the disease, if the critics of Keynesianism are right. It's that the disease is being caused by the so-called cure, that what the Keynesians are administering as medicine is actually the poison in the first place. And then what they're seeing now is, oh, wow, this patient's really sick. It's because the Keynesians administered their treatment the last cycle, and that's what is causing this patient to come in. And so they're, I guess we just got to give them more. Okay. So in reaction to that hydraulic Keynesian, the Chicago school types, and then also economists associated with like the Minnesota is also big in this. I think also at the University of Rochester, there were some, what came to be known as real business cycle theory, or RBC. And so this was developed like in the late 70s and mid 1980s is when this was really fleshed out. And so as the name suggests, a real business cycle theory is a complete reaction against Keynesianism. Remember, so the Keynesians focused on just money and spending, and the real business cycle theorists said, no. The problem when there's a recession, that's a real phenomenon, meaning there's something going on with the physical economy and the movement of wheat and factory output and things like that. That's where we got to explain things. And so the real business cycle theorists said what happens is there are shocks to the economy, and what we see as a recession is actually the, quote, rational response to those shocks. And that's how they explain things. So they were saying at any given time, there's uncertainty, and that people are operating, entrepreneurs are making their plans for what their businesses are going to do. Workers are deciding whether to take a wage offer or not. Home buyers are buying mortgages with expectations about the future and, how much do I think I'm going to make over time? And so can I lock myself into a 30-year mortgage with these fixed monthly payments, blah, blah, blah. Okay, so they're all doing this stuff, but they could be wrong. And so the idea is the RBC theorists built internally consistent mathematical models of the economy where everybody had what was called rational expectations. So that's why their models were considered superior to the old Keynesian models. Because again, those old Keynesian models relied on what was called money illusion, where among other features, the way you restored full employment was that the workers actually ended up taking a pay cut, but they didn't realize it. All right, so let me just spell that out a little bit. So in the old Keynesian vision, if there's a recession, you might have thought, relying on the classical school, that, if labor's too expensive right now, if the employers don't want to hire all the workers who want to have a job, just wages need to fall. It makes labor cheaper. And at some point, the employers will say, okay, I didn't want to hire that many workers when wages were $20 an hour. But now that they fell to $16 an hour, I'm willing to hire more workers because they're cheaper. And then at some point, as wages fall, just all the available pool of unemployed workers gets sucked up. And that's how the market economy should fix itself. You shouldn't have 10% unemployment dragging on year after year. No, wages should just fall and fix that, right? Just like if there was a glut of apples, like there was an unusually big harvest and the orchard owners just had a bunch of apples sitting there, what would they do? They'd mark down the prices to move that product before it got rotten. And it's the same thing with workers. You got a bunch of workers sitting around, can't find work, lower your wage demands. And so the Keynesians explained that no, that doesn't work sometimes under certain circumstances, because if you cut their wages in money terms, so one thing is the workers can really see that, so they might resist that and not want to work more. That might hurt morale for the existing workers if their wages get cut too. But also it could be like a vicious downward spiral where if now the workers in general have less money, well then now when they go to the store, they can't spend as much. And so that means business revenues in the aggregate at least go down. And so you might think, by workers' wages going down, the business profitability goes up, and so now it can get ahead. But no, if there's a feedback mechanism, and by all the businesses in general trying to cut their wages at the same time, that means business revenue in general falls also. Well, then you're not getting ahead anywhere, right? So that was the Keynesian explanation for why old school just wage cuts didn't work. But so the Keynesian solution of just dump more money in the economy through a combination of this, the central bank creating it and the federal government borrowing it and deficit spending it. The way that actually worked was worker wages were rising in money terms, but general prices were rising even faster. And so that was how the Keynesians thought they would solve that problem, is workers were becoming cheaper from the point of view of the employer, right? Because it wouldn't be enough if just wages and prices rose at the same time or by the same amount. Because if there was 10% unemployment in the original scenario, and now wages and general prices all went up 8%, that yes, business revenue goes up 8%, but if wages went up 8%, well, then the firms still shouldn't want to hire more workers, right? And so you'd still expect unemployment to be 10% or whatever I said. Okay, so the only way to make the firms hire more workers is to make them relatively cheaper. But again, I've explained why there was problems with trying to do that by just directly reducing the money wages paid to the workers. And so in the Keynesian solution, again, that was implemented in the 50s and 60s, was to say, we're going to dump more money in that will make prices rise more than wages. So the workers still feel like they're getting more money, so they're happy, so they're not discouraged, it doesn't hurt morale. But the employers are happy because actually the workers are becoming relatively cheaper. So again, the point was they guys like Milton Friedman and Robert Lucas said, this is violating what we now call rational expectations, that the only way this works is if the workers are fooled and they think they're getting a pay raise, but really they're not. If it's not keeping, and they're saying, yeah, maybe in the beginning before they realize what's going on, that will work. But over time, that medicine's going to lose its potency. And you're going to have to just start doing more and more injections of money to get a smaller and smaller effect. And that is what happened over time. Okay, so the real business cycle, RBC models, theoretically speaking, just in terms of economic science and the professional academic economists evaluating things, the real business cycle models were deemed superior in that respect, that the people in the model, and these models are very simplistic. It's not like there were millions of workers or something. There's like one representative agent who is the consumer and the worker, and maybe one business that has a production function and maybe a central bank. Like, these are very simple models because the math gets really complicated. So you can't make the model too complex with a bunch of moving parts, because then it just would be unsolvable, especially back in the late 70s, early 80s, before they had computers helping them as much. So the point was, in the RBC models, everybody knew what was going on. So nobody was making a systematic mistake, or there was no money illusion. Okay. So that's at least in a statistical sense, right? So people could be caught off guard, but they understood the structure of the model. I'm trying to catch myself here and make just true statements, but the stuff gets pretty nuanced. So anyway, I think what I'm saying for the level of this discussion is accurate enough. Okay, so that was the idea. And so what they could do is they would come up with models and they would show how, like if there's a shock, that if all of a sudden the agricultural output is lower, just because of seasonal fluctuations and whatever, that can cause a business cycle. So in the world of the model, they could show how, given that there are shocks to productivity, either positive or negative, that could cause cyclical output. It would be, quote, rational in times when labor productivity was relatively low because there was a negative shock to labor productivity. You could see it would make sense for businesses to not hire as many workers in those periods and just wait for the shock to wear off, labor productivity to go back to its historical norms. It would be trending up over time as the economy accumulates more tools and equipment and stuff. So workers, raw labor is aided by more machinery. So over time, a worker in 1980 is more productive per hour than a worker in 1960. But within that general upswing, there's ups and downs. And so the RBC models could show how in the world of the model, you could simulate and get it to be that the, quote, rational outcome is that, when there's a negative shock to labor productivity and workers in general aren't making as much per hour, and given that workers aren't robots, right? Like, other things equal, workers don't like to work. That's just a means to an end. That's another way of saying people enjoy leisure. Leisure is a consumer good. Given that, it makes sense, it's, quote, optimal in the face of these unavoidable shocks, that when people are caught off guard by an unusually large negative shock, the rational response is for workers to enjoy more leisure in those periods, right? Because the trade-off has changed. Okay. Just to kind of give you the intuition behind that, just like you would say, it could make sense that if you broke your leg and you're a worker, you probably wouldn't go into the factory for a few weeks. Okay. And you just think through why. Whereas there could be scenarios where if you're on a sinking ship and you break your leg, you're still going to be doing your part to take the bucket and try to get the water overboard as you and the rest of the crew try to prevent the ship from sinking. Right. So you can see, depending on the circumstances, just a broken leg may or may not mean the, quote, rational thing to do is to stop working. Okay. And so likewise, in a modern economy with millions and millions of workers all doing different things, the RBC models could show it could be optimal if there's a shock and a bunch of the workers for some reason become relatively unproductive for a period, the right thing to do, rather than having them still continue to work when what we get for it isn't very valuable for at least a period there until conditions change. It's not worth it. That it's better for them just to remain idle. Okay. So they could do that. So now the problem with that, though, is, for one thing, it felt phony. Like, yeah, in the model, you could go ahead and simulate that stuff, but it didn't seem like that was a metaphor for what was really happening in the market economy. And some Keynesian critics made fun of that. They would say, like, oh, So according to the RBC theorists, what happened in the 1930s, it wasn't the Great Depression, it was the Great Vacation, right? And so they were being a bit harsh perhaps, but that wasn't completely unfair to say that, because there was a sense in which that was the RBC position, to say even in the midst of the Great Depression, it was just, there were really big negative shocks. And so the optimal thing to do was for that 25% of the labor force to stay home in that period in 1932 in the US, when the unemployment rate was 25%. Okay. And so pushed to the extreme, it just seemed like, it's probably not that there was real shocks to some, like, it seems that no, there's something going on with money and banking, and surely that has something to do with it. And the fact that the stock market, had a bubble that crashed, surely that has something to do with it. Okay. So I think that was the flaw of the RBC models. Even though they were internally consistent, they were sort of an intellectual masterpiece because the math behind them was quite complicated, and the people doing it were very good at math. They were smart, but the idea was just, it didn't seem like that was a model of what was happening in the real world when market economies would be plunged. First, they would have these big booms and then a crash. Okay, real quickly, the Post-Keynesians, I don't know them as well, but like one of their heroes is Hyman Minsky. You may have heard of a Minsky moment. And so I like them insofar as they focus on monetary and credit circumstances. Like they can explain how financial market excesses could lead to a, quote, real business cycle or a slump. Okay. I disagree with their recommendations, but I like the spirit of what they're trying to do. And so that's why I can kind of get along with guys like Steve Keen, if you know that name. We can have a respectful disagreement on that stuff because we both agree that the standard approaches are leaving a lot out, and that they're not even, just to give you an idea, in 2022, the Nobel Prize in Economics went to Bernanke and Diamond Dybvig for their work on explaining how the banking system has something to do with the business cycle. And they were very crude models. And the point was not so much, oh, thank you guys for taking what we all use in terms of the banks and how they contribute to the business cycle, and you guys just made our understanding deeper. It was more like, oh, these guys are really onto something here. Yeah, banks probably do have something to do with the business cycle. I mean, I'm exaggerating a little bit here, but not by much. Okay, put it to you this way. I was at NYU getting my PhD in economics from 98 to 2003. And the standard models we learned in our macro sequence in terms of understanding the business cycle, commercial banks were not in the model. There would be a central bank that would like set the interest rate and things like that, or the stock of money maybe. But it wasn't that there were banks in the model that firms had to borrow from or the consumers either lent to or borrowed from. Like none of that happened. So the idea of a business cycle occurring because of something happening in the financial sector literally couldn't happen in the models that we learned, just the standard suite of models, because there was no financial sector. Or if there was, it was very crude. It was just real simple stuff like shared, titles to some tree that was shooting out coconuts or something. Really simple stuff about asset pricing at best, but not banks that could screw things up. Okay, so I'm saying the post-Keynesians, I will give them that, is that they understood, hey, in modern market economies, to understand business cycles, we probably want to focus on the financial markets and how problems there can spill over into the, quote, the real economy. Okay, but that's as far as I'll take on the post-Keynesians, because I'm not as familiar with them. And in general, I disagree that they think, oh, and so because distortions in the private financial markets can cause a business cycle, that's why we should have more government regulation and we got to have all these safeguards put. And I disagree with that. I just think that's wrong. And I would say, no, it's actually misguided government interventions in the financial sector that help cause the problem in the first place. All right. Okay. Finally, now, with all that preamble, let's talk about the Austrian school. So here, I think they combine the best of all the different schools of thought, all the germs of truth they all have. I think the Austrians bring it all together. So specifically, the Austrian theory is one where there are monetary causes of the business cycle, but it is implemented through real effects or real phenomena. Okay. And so I couldn't find the exact quote, but I think it was Fritz Machlup summarized it by that it would be wrong to try to take the explanation of the business cycle that Ludwig von Mises developed and say, oh, is it a monetary theory or is it a real theory, right? If by monetary versus real, you have in mind like the Keynesian, like, oh, recessions are just about aggregate demand. We just got to spend more. Or the real business cycle people that say, no, it has nothing to do with money and spending. When you want to understand the business cycle, you got to look at the underlying real shocks to productivity. Like, harvest fails or something changes with the terms of trade internationally and oil becomes more expensive. And so that's a real shock to the net importers of oil, whatever. That's also inadequate. And so the Austrian approach, I think, correctly takes into account both issues. So yes, the Austrian approach fully recognizes the role that money plays and how the economy actually isn't just a bunch of barter transactions. And so because money is on one side of every transaction, if something gets screwed up with money, that can have system-wide effects. So that's the Austrian nod towards, the monetary factors. And in particular, the banking system, especially because of its ability to, in a sense, create money under what's called fractional reserve banking. Once you understand monetary disturbances, then you see how the banking system can come into play and might also screw things up. However, the Austrians recognize that what happens here is during the boom period, malinvestments occur. Right? So this is critical, the distinction between overinvestment versus malinvestment. So some people, when they encounter the Austrian theory of the business cycle, they think the Austrians are saying that, there's too much investment. And that's not the case. The Austrians, they're not lamenting too much investment. It's investment in the wrong lines. Okay. And so then because of that, once the economy goes down the path of an unsustainable, illusory boom, there necessarily has to be a crash. Right. And so that's really the distinctive element of the Austrian view, and why when the economy starts tipping into recession, you're not doing it any favors by slashing interest rates, pumping in credit, and having the government run budget deficits. There's a sense in which, no, the crash is actually the return to more sustainable growth. Okay. Friedrich Hayek, who was a student of Mises, had a line, I'm not going to get it exactly right, but he says something like, in the context of explaining business cycles, he says, before we can understand how things can go wrong, we must first understand how they could ever go right. And so what he's saying there is, I'm elaborating, paraphrasing, but his point is to understand why is it the market economy might sometimes fall into a slump. You first need to just understand the day in, day out normal progression and how is it that our standard of living rises over time. And because what you need to understand is that's a very complex process. And in general, it's not something that central planners, whether they're central bankers or members of the Communist Party or what have you, are going to be able to coordinate and organize. And so in particular, the market economy relies on the price system to help communicate that information to everybody in the system so we can all work in a coordinated fashion. And one of the important prices is the interest rate, or more generally, interest rates for various types of credit risk and durations, right? That's how the household is saving, living below their means, that then gives resources to people who want to borrow, like firms that want to build factories or whatever that aren't going to come online for a few years. That's how all that gets organized in a market economy, is the price system of profit and loss. Accountants can at least ex post tell the entrepreneur, yep, these branches of your firm did well, these ones didn't. And that's kind of the way that the market economy husbands scarce resources and gives feedback, both positive and negative, to the various entrepreneurs to say, are you doing a good job with society's scarce resources? And the ones that are profitable are, the ones that are making losses are not. And that's kind of the regulatory mechanism. And so among other elements of this, the interest rate is like the price of time. Again, I'm being a bit simplistic here for the level of this episode. And so other things equal, if the household become more future oriented, become more patient, become more willing to defer present consumption for consumption down the road, what do? They increase their savings so they can give more to banks or other types of credit intermediaries, financial institutions, whatnot, that pushes down interest rates, that makes it easier for firms to borrow. If there's projects that are very long-term oriented, like someone wants to build an apartment building where there's a lot of upfront costs and then a long horizon of rental payments over decades, that type of project is very sensitive to interest rates in terms of the present discounted value of that. Again, a bunch of high upfront costs and then a flow of net income for decades into the future. So there, at a discount rate of 8%, maybe it's unprofitable, but at a discount rate of 6%, now all of a sudden it's profitable. You go ahead and do it. All right. So that's the idea in the Austrian framework by which when the central bank or the banking system in general floods the market with credit and pushes down interest rates, if the reason that's happening is because the households have genuinely saved more, then that's a sustainable expansion, right? That output shifts from making pizzas and television sets, shifts out of that and towards making drill presses and 18-wheelers and factories, right? So it just redirects the flow of output to more future-oriented things, and that's all sustainable. And then it just shows how workers' productivity rises over time. That's fine. There's no boom bust involved. That's just the general upswing of a standard of living that you expect in a market economy. The problem, though, in the Austrian view, is that if the influx of credit and lower interest rates is not tied to households living below their means and saving more, but it's just because the central bank decides to create more money, or the banking system, through what's called fractional reserve banking, just decides to issue more loans, even though households haven't bought more CDs or put more into their savings accounts. Well, now you've got a problem, because now the lower interest rate and the extra credit that is available to lend to businesses is still giving the same signals that it would if there really is an increase in genuine saving, but nobody in the economy has reduced their consumption. And so now the households still feel wealthy. Their standard of living is not dropping. They're not consuming any less. But the businesses now think, oh, we have access now to capital. We're allowed to start building this long-term apartment project because interest rates fell from 8 to 6. And so now my CPA tells me this project is positive in terms of net present value. So I'll go ahead and start it. So there's this general upswing, this euphoria that the construction firms, wherever they start building the apartment complex, are bidding away workers, but the pizza shops are not laying off workers because households are still going there and buying pizza like they were before. So now unemployment drops. There's this general, businesses are scrambling to hire workers and to buy scarce resources because, again, the consumption spending from the households is what it was before. And now the businesses are doing more investment spending. Okay. And so it's not that the economy is redirecting and just slowing down, reducing the output of pizzas and television sets to increase the output of 18-wheelers and drill presses and factories. No, now it's trying to do everything at the same time. I can't get more nuanced and specific here for the purposes of this episode, but the idea is Mises developed, and then Hayek and other Austrians in their wake have tried to elaborate on this as to it's not that the problem manifests itself immediately, that there's enough slack in the economy, there's enough goods already in intermediate stages of production, that the structure of production going from putting fertilizer in the ground to then getting the wheat and taking it, turning it into flour and so forth, and then the baguettes that end up at the grocery store, there's a time lapse there. And then for other things, it's an even longer time lapse, and especially if things that got to get put on a ship and go across the ocean. And if you kept tracing it back to the minerals that were first taken out of the ground, it could be many-year process of the whole structure of production, from the beginning of taking raw stuff from nature till the final good that a consumer's buying at Walmart or at Best Buy or something. Okay, so the point is, in that early stages, once the markets are flooded with cheap credit that doesn't correspond to genuine saving by households, that can cause this general feeling of euphoria where it looks like every business is doing well and everybody's trying to hire workers, so unemployment drops, workers' wages are getting bid up, everything looks great. And the problem, though, is it's not sustainable. So yes, it can go along like that for a few years for the reasons I talked about, because the structure of production is so long that if there's a disturbance, you might be able to persist in that for several years before there's unavoidable hard facts of reality hitting a brick wall. Okay. And so that's what the unsustainable boom is. And then in the Austrian story, ultimately what happens is the banking system and or the central bank get nervous because they start seeing pockets of prices exploding. They take their foot off the gas. They stop flooding the market with so much artificial credit. That makes interest rates rise, and then the bust happens. Okay. So to me, that captures all the important elements of a real world business cycle. All right. I will stop there. I think that's a good resting point, and you can see why this isn't just an academic curiosity of college professors arguing some minutia that doesn't affect anything. This is the fate of the world economy hangs in the balance here, especially because, like I say, if the Austrians are right, this is what I'll conclude with. If the Austrians are right, then the conventional Keynesian solutions to a recession, namely by having the central bank come in and artificially lower interest rates and or having the federal government deficit spend, those are just sowing the seeds for the next crash. That's just what it's going to do is it's going to, quote, solve a recession just by bringing in another unsustainable boom. And the only way we're going to get out of this boom bust cycle is by just letting the market find its natural bottom, letting resources get reallocated to where they really should be, a more sustainable niche. And then we can have solid, sustainable growth going forward based on genuine market prices, real interest rates that are actually corresponding to genuine household savings and so forth. And that's the only way to get out of this cycle. But what we're doing now, central banks and governments around the world, they don't want to tolerate that pain. Just the moment the patient starts to feel sick, they just dump in more. People have used the analogy of somebody addicted to a drug, and that the way to get them off is to go cold turkey, and the withdrawal is painful, but that's how you get out of it. Whereas the Keynesian solution, if the Austrians are right, is to just keep giving more and more higher doses of the drug to say, oh, look at this poor patient, how painful withdrawal is, let's give them more heroin. And that will make them feel better. And that will ease their pain in the short term. But obviously you're not doing anything for that patient in the long term with that strategy. Okay, as I say, I'll put a bunch of links in the show notes page if you want to see more reading on this or even videos. Thanks for tuning in, everybody. See you next time.